Today is a milestone day because after 9 years, my credit has finally hit 800 mark. I've come close before reaching 799, but never quite made it until now. This milestone means a lot because it represents financial health and responsibility, and I can finally make a video about how to achieve this score. So why does your credit score matter? Think of it as a report card for your finances. Just like getting good grades in school, maintaining a high credit score shows that you're good with managing your money. A great score can save you money on loans and interest rates and even make you money in the long run. Here's why a good credit score is valuable. Lower interest rates. Whether you're buying a home, a car, or financing a business, a high credit score means you qualify for the best interest rates. This can save you thousands of dollars. Another thing is better loan terms. It can also mean lower fees and better terms on any loan or credit you apply for. Credit card perks is another thing. You'll have access to the best credit card offers, including those with great sign-up bonuses and rewards. If you follow the tips in this video, I guarantee you can save or make a few $1,000s and it won't cost you anything out of pocket. All it takes is a little time and effort. Steps to achieve a perfect credit score. 1. On-time payment history. 35% of your score. Always pay your bills on time. Missing payments can significantly impact your score. Your payment history is calculated by dividing your on-time payments by your total payments. Aim for 100% on-time payments to stay in the green zone. To elaborate, here's how this works and how it's calculated. The credit bureaus look at all your on-time payments and divide that by your total payments. For instance, if you had one credit card for 60 months and missed one payment, you'd have 59 on-time payments out of 60 total payments, giving you a 98.3% on-time payment ratio. According to the Credit Karma score calculator, this would place you in the yellow zone, which isn't good if you're aiming for a perfect score. In a different example, if you've had two credit cards, each for 60 months, and missed one payment, you'd have 119 on-time payments out of 120 total payments, giving you a 99.1% on-time ratio. This is a bit better and places you in the green zone if you're just starting and have had a credit card for 15 months and missed one payment. You'd have 14 on-time payments out of 15 total payments, which is only 93.3% on-time payments. This is bad and will place you in the red zone. The key is to prevent this from happening by not missing payments and having more credit available over a longer period. For example, having 10 credit cards open for 5 years would give you a 600 total payments. And if you miss one payment, it's a 99.8% on-time ratio, which is not the end of the world. For paying off credit cards on time, the good news is that to count it as an on-time payment, you just have to make the minimum payment each month, even if you can't pay the full amount. Making the minimum payment will help keep your score intact. Second, credit utilization. That's 30% of your credit score. Keep your credit card balances low compared to your credit limits. Ideally, use less than 10% of your available credit. For example, if you have a credit limit of $10,000, try to keep your balance under $1,000. Credit utilization is a measure of how much credit you're using compared to your credit limits. For example, if you have a credit card with a $10,000 limit and you spend $6,000, you're using 60% of your credit, which is bad and places you in the red zone. If you pay off the $6,000 in full, you have a 0% credit utilization, which is excellent. It's not about the dollar amount, but the percentage of the credit used. If you have a $300 credit line and spend $300, that's 100% utilization and very bad. But if you have a $30,000 credit line and you spend $300, that's only 1% utilization, which is excellent. One technique to keep your utilization low is to have high credit limits. For example, I have multiple credit cards, many with $20,000, $30,000 limits. I have never spent that much, but it helps keep my utilization low when I do spend more. Another myth is that you should keep a small balance on your credit card to improve your score. It's not true. It's false. It's a myth. Always pay off your balance in full to avoid interest charges. The third one is length of credit history, which is 15% of your credit score. The longer you've had credit, the better. Start building your credit as early as possible. So don't close old accounts, even if you don't use them. They add to the length of your credit history. This factor looks at the average length of your credit history, not the total length. If you opened one credit card 4 years ago, your average length is 4 years. If you open another credit card today, your average length drops to 2 years. Closing old credit cards can also lower your average length. So like I said, even if you don't use it, keep it open and don't close it. Just leave it there, and that will increase your credit because it lowers your credit utilization. Start building your credit early, even as soon as you turn 18, to establish a long credit history. Keep old accounts open to maintain a long average length. My grandma, for example, she's terrible with credit.
Wesley.
I would never tell her to go and get a credit card because then she'd just max it out and then she'd be up a creek without a paddle. So we don't want that. The fourth one is new credit and credit mix, which is 10% of your credit score. Don't open too many new accounts in a short period of time. Each hard inquiry can lower your score temporarily. A mix of credit types, credit cards, auto loans, mortgages, shows that you can handle different types of credit responsibly. Opening new accounts results in hard inquiries on your credit report, which can temporarily lower your score. Multiple inquiries in a short period can be seen as risky. However, if you're shopping for a mortgage or an auto loan, multiple inquiries within a short period are usually treated as one inquiry. So for example, I am a realtor in Silicon Valley Bay Area, and I work with multiple buyers. And if they are getting a loan, they need to submit what's called an application to a bank to get a pre-approval. Now, if you want to interest shop and you want to check with multiple banks to make sure you're getting the highest interest rate possible, then chances are you're gonna have to run your credit multiple times, which may scare some people because that's going to hurt your credit. However, when searching for a loan, let's say Wells Fargo, for example, you're checking with Wells Fargo, you're checking with Bank of America and Citibank, and you want to check with all those banks, maybe even US Bank, you can do that usually within a 2-week span. That's not going to ding your credit twice. It's only going to ding it once. So that gives you some flexibility to interest rate shop who's going to give you the best deal and who you appreciate working with the most in order to get the best interest rate when buying a house. Now, keep in mind, check in your area with your loan officer and make sure that's the case for you before moving forward. But typically in our area, it's about 2 weeks before it's going to ding your credit again. A mix of credit types demonstrates your ability to manage various types of debt. For example, having a mortgage, auto loan, and credit cards shows lenders you can handle different credit responsibly. So the fifth one is the total amount of inquiries is 10% of your score. Each time you apply for new credit, it results in a hard inquiry on your credit report. Too many inquiries can lower your score. Hard inquiries stay on your report for 2 years, but only affect your score for the first 12 months. If you apply for multiple credit cards or loans, each application results in a hard inquiry. This can make you appear as a riskier borrower. The more inquiries you have, the lower your score may be. If you're rate shopping for a mortgage or auto loan, multiple inquiries, like I mentioned, in a short period are usually counted as one. And like I said earlier, if you're within that 2-week time frame, typically it's not going to hurt your credit, but after those 2 weeks, don't run your credit again. You don't do that. You're gonna ding it twice and then you're gonna be mad at me for telling you to do that, which I didn't tell you to do that. So my final recommendations: check your credit score regularly, use free services like Credit Karma or other services. Now, sometimes it takes some time to update your credit on Credit Karma or other various sources, apps that you check your credit. So if you do pay off your credit cards today, it may take a month before it registers on Credit Karma. So don't freak out that it's not updating your credit. It may take a little bit. Now, this is a good idea if you're young, is credit piggybacking. Become an authorized user on someone else's credit card to benefit from their good credit history. This can also work if you're a stay-at-home mom or you're a spouse that's not working and you also want to have good credit. This is a good way to piggyback off of someone else's credit in order to raise your credit. That way, one day, if you do start working again, and you'll have good credit to go finance whatever you want. But if you are young, I would recommend at 18, as long as you're responsible, to get a credit card, start building your credit, and roughly about every 6 months, you can request a credit increase. So keep those payments low, always pay them off. You can even pay it off before the due time. Don't wait till you owe and you get a bill to pay it off. Pay it off early if you can. Everyone has a smartphone, so you can just pay it off as soon as you get charged on it. It's going to increase your credit. Every 6 months, you can go ahead and request a credit increase. And that's really gonna help your credit. And then after a year, you can do another one and add another credit card and then boost your credit that way. And then with those 2 credit cards or multiple credit cards, every 6 months, you can request a credit increase to get multiple credit to increase your credit score. Another one is stay consistent. Follow these tips consistently. Manage your credit responsibly, and over time, your score will improve. Remember, having a score above 760 is usually sufficient for getting the best rates and terms on loans. Anything above 800 is mostly for bragging rights. So aim to maintain a score in the 760 and 780 range to maximize your financial benefits. Please reach out in the links in the description below. Thank you so much for watching. If you found this video helpful, don't forget to like, comment, subscribe, and as always, see you in the next video.